Welcome to another tutorial video. This time around, as you can see, we're going to be talking about Snap. As I record this, the company has recently gone public within the past few weeks, and everyone is talking about the company and one question specifically, which is it overvalued? How could a simple app be worth 20 or 30 billion US dollars? So in this lesson, we're going to delve into this question. We're going to go through a simple valuation and DCF analysis that we constructed for Snap, which you can also download below this video. Before I begin, I do want to add a disclaimer and say this is not investment advice. It's for information and illustrative purposes only. It does not purport to show actual results, and it should not be regarded as investment advice or a recommendation regarding any particular security or course of action. Seek a duly licensed professional for investment advice. We're not going to tell you whether to buy or sell this company's stock. We are just going to weigh in on the valuation and how the company's price might compare to its current value. So is Snap overvalued? The short answer is yes, but not by quite as much as you might think or by quite as much as other people have given the impression of in their analyses of the company. The company's current value, around $20 or $21 per share as I record this, equates to an equity value somewhere between 25 and 30 billion, about 26 or 27 billion specifically, is not absolutely insane, but at that level, the company is most likely extremely undervalued or extremely overvalued. The way we set up our analyses, we don't really see middle of the road outcomes as particularly likely here. Potentially, there may be about 2x upside and about 4 to 10x downside. So the company's true value might be about twice its current share price, or on the downside, it might be only about 25% or 10% of its current share price. For the company to be valued appropriately, you have to believe that there is roughly a 40% chance that it will become the next Facebook. So before you make any recommendations or have strong views, just think about that probability for a second. Do you really think there's a 40% chance that Snap will become as successful as Facebook has been? A lot of other people have weighed in on the valuation of this company, and I've looked at analyses from a lot of different sources, both in the industry, academic sources, and others. These analyses have some merits, but I disagree with a lot of what I've seen for a couple key reasons. First off, a lot of analyses have focused on multiples, like enterprise value to revenue or enterprise value to active users, monthly or daily active users, for example. But generally, multiples are useless for high growth and rapidly changing companies like this. There are some cases in which they're useful. For example, if the company isn't yet generating revenue and you need some way to value it, but Snap is generating revenue, it's very cash flow negative and has negative margins, but multiples are not that useful in this case. Most people also haven't explained the reasoning behind their revenue growth and margin assumptions and cash flow assumptions in a DCF. So I've seen some DCF analyses where people have just entered growth rates and margin assumptions, but they haven't linked it to anything in real life or linked it to peer companies in the industry and how they have performed. Finally, we think most people are looking at this company on too short-term of a basis. You can't assume that a startup company like this is going to mature in only 5 to 10 years. We think that a more realistic period is more like 20 or 25 years. So we go out quite far in our analysis, further than most of the other valuation that I've seen regarding Snap. Here's how we're thinking about the company. For a high growth, high risk, super speculative company like this, we think that 3 outcomes are possible. Outcome number 1 is that it turns into a Facebook-like success story, with daily active users and average revenue per user approaching Facebook's. Outcome number 2 is a Twitter-like story, where it's not a failure, but it's also not a huge success story. Daily active users and average revenue per user will be closer to what Twitter has achieved recently. And then outcome number 3 is the crash and burn scenario, where daily active users and average revenue per user only rise modestly over their current levels, and even 10 years into the future, the company's audience and revenue are not that much bigger than what they're at right now. So the key drivers in this type of analysis will be, first off, the daily active users. This is a huge driver for any social media or internet company. Snap's daily active users were about 144 million on average over the past 4 quarters and its last fiscal year. No one really thinks the company's going to get to 1.2 billion users like Facebook, but there's some debate over whether it's going to stay closer to 300 million or 600 million in the long term. Another key driver is the average revenue per user. So the company has a certain number of users, and then it makes a certain amount of money from each user. Facebook's average revenue per user is around $20, Twitter is around $5 or $6, and Snap is at $2 to $3 right now. The operating margins are also extremely important. It's great to generate money and get a large audience, but if you cannot actually keep that money by spending less than you earn, then the company is effectively worthless. At some point, it has to turn profitable and cash flow positive. Now, Facebook has always had pretty healthy operating margins, 45 to 50% historically. Going forward, they're projected to be about 55%. Twitter's operating margin is still negative, but we'll be optimistic and say 25%. That's actually their projected EBITDA margin, but we want the cases to be a little bit different, so I am going to assume 25% in that case. And then other items in a DCF, like depreciation and amortization, capital expenditures, and the change in working capital, all are fairly low percentages of revenue, 3 to 5% by year 10 in our analysis. These are not that significant for Snap because the company doesn't own its own assets and servers in the same way that Facebook and Google do, for example. So many of these numbers are going to be smaller and less significant for the company. So here are the scenarios that we're looking at in our analysis. I'll go through the numbers now and then show you what these look like in Excel briefly. In the Facebook case, the company gets to 600 million daily active users over 10 years, with average revenue per user going up to $30. This is actually higher than Facebook's number right now, but 10 years into the future, Facebook's number will also probably be higher. Operating margins hit break even in year 5 and then reach 40% by year 10. So let's take a look at what this looks like in Excel. For my scenario, I have Facebook selected right here. And then for the daily active users, you can see that by year 10, by the end of phase 1 in our multi-stage DCF, the company has 595 million users. You can see the growth rates for the users right here. And then for the average revenue per user, you can see it increasing over time and going up to around $31 by year 10. You can see the growth rates right here. And then as a result, the company gets to revenue of around 18 or 19 billion right here. Its operating margins are very negative at first, but we assume that they hit break even in year 5 and then increase gradually, actually rapidly, and go up to 40% in year 10. And then in the maturity period, all these numbers basically stay the same. Average revenue per user only goes up modestly. The user count only goes up modestly. And effectively, the company reaches maturity by year 20 in our analysis. And the operating margins are still 40% by then. If you're wondering why we've assumed lower margins than Facebook, it's because Facebook owns its own servers while Snap uses Google Cloud. As a result, Snap is going to spend less on CapEx, but more on operating expenses. So its CapEx as a percent of revenue will be lower, but its operating income as a percent of revenue, its margin will also be lower. And then in the Twitter case, we've said 400 million users over 10 years, which is actually above Twitter's count by a good amount. Average revenue per user will go up to $8, which again is above what Twitter has. And operating margins will hit break even in year 6 and 25% by year 10. So here's the Twitter case. When I set the scenario to Twitter-like right here, the average daily active users go up to around 387 million by year 10. Average revenue per user goes up to around $8.41. Revenue hits around 3.2 or 3.3 billion, which is actually pretty close to what Twitter's revenue is at right now, around 2.5 or 2.7 billion. And the operating margins hit break even and rise to about 25%. And then in the stabilized period, the maturity phase, they stay at that 25%. And by the end, the company has 4.5 billion in revenue by year 20 and operating income of around 1.1 or 1.2 billion. And then finally, the crash and burn case. The company gets to around 200 million users, which is a very modest increase over what it has right now, and average revenue per user of $5 by year 10. Operating margins climb to 10%. This effectively assumes the company is stagnant and barely improves at all over the course of 10 or 20 years. So in this case, the crash and burn scenario, let's take a look at the numbers. So average daily active users over the course of the year goes up to about 225 million. Growth rates are very low, 1% by then. Average revenue per user is only $5 by this point. And again, growth rates are pretty low, 5%, 4%, 3%, 2%. Revenue only goes up to about 1.1 billion from the 400 million that it's at right now. Operating income does turn positive, but it remains very low. Operating margins are only 10%, which is quite a bit lower than other social media, internet, technology, and advertising companies. In terms of other assumptions for the DCF, depreciation and amortization as a percent of revenue is about 9% for Facebook, 13% for Twitter. But again, Snap uses Google Cloud, so we've assumed numbers that are quite a bit lower for the company. We started out at 13%, which is sort of in between its historical numbers, and then it declines to 3% over time, and then over this 20-year period, it stays at 3% of revenue. CapEx as a percent of revenue is quite high for Facebook, 16%, 9% for Twitter. Snap doesn't own its assets, so we assume 5% in the long term for them. It starts out at around 16 or 15%, matching its historical levels, but then it declines to 5% and stays at that level. We assume that CapEx stays ahead of D&A because we assume the company's asset base keeps growing over time. The change in working capital as a percent of the change in revenue historically was around 43 or 44%. We have it going to negative 20%, and then eventually it flips and goes to about 3%, which matches what Facebook has traditionally recorded. And we think that's a reasonable assumption for a rather mature social media company like this. And then the discount rate. So over on our WACC analysis tab over here, if you use Facebook and Twitter as comparables and you go through the traditional analysis, unlevering beta for them, and then relevering beta based on the optimal capital structure or Snap's current capital structure, WACC comes out to around 7.5%. Now, initially that may seem reasonable, but remember, Snap is still a much earlier stage company than Facebook or Twitter. And if you look at earlier stage internet companies, the discount rate tends to be more like 10% to 15%, something in that range. So we think a 12% rate is more appropriate. And so in our analysis, we start the discount rate at 12%, we make it decline each year, and we use this cumulative discount factor to factor this in and to account for this decline. And then eventually by year 10, it hits 7.5%, and then it stays at that level all the way through year 20 as the company stabilizes and matures. And then, of course, when we get up to the top and we calculate terminal value, we use that terminal discount rate for the terminal value to discount it to its present value. We use both the multiples method and the Gordon growth method for terminal value. I'm going to set this to the Facebook-like case for now. If you look at the multiples, Facebook, Twitter, and Google, as of the time of this analysis, trading at forward EBITDA multiples of around 11 to 15x. So we assume a discount to those multiples, and we say 5x, 8x, or 10x, depending on the case. The reason why we assume a discount is because of the implied growth rate. Whenever you assume a multiple like this and use it to calculate the terminal value, you're also getting an implied growth rate with that. So if we looked at this and said, okay, well, let's just pick this 15x multiple that Facebook and Twitter are at. If we did that, our implied long-term growth rate is 3.9%, which exceeds the US GDP growth rate in the long term by a long shot. You're looking at around 4% versus 2.5%, something in that range for the economy. So it doesn't really make logical sense. As a result, we set it to a lower number. And the same applies for these other cases. We picked lower multiples that made sense given the company's lower profile and the implied growth rates that made sense in these cases. For the Gordon growth method, we picked growth rates that lined up with our multiples. So we have growth rates of 2.2%, 1.5%, and 1.1%, depending on the case, versus a long-term GDP growth rate of 2.5%. So the results of this analysis are as follows. In the Facebook-like case, if you look at the output here, the company's implied share price might be between $40 and $50. So it's worth about twice its current share price if you assume a Facebook-like outcome. If you assume a Twitter-like outcome, the implied share price is around $5, and we could be generous and say that it is between $4 and $6 in this case, so it's a huge discount to the company's current share price. And then in the crash and burn scenario, you can see the implied share price is around $2 to $3 right here. So once again, a massive discount to the company's current share price. Now, some people in this scenario would say that we should probability weight these results or use a Monte Carlo simulation or do something else like that, but we think it's very speculative. It's also hard to justify the weightings and the assumptions. If someone asks you in an interview, how did you come up with a 15% probability for this, or a 10% probability for this, or an 11% probability for this, you're going to have a very hard time answering those questions. Our view is that valuation is more useful for assessing the best case outcome and the worst case outcome. It's better to be vaguely right than precisely wrong. You want to find cases where the company's mispriced by a huge amount, where the company's worth only 10% of its current share price, or where it's worth 5 times its current share price. You're looking for those extreme cases because the margin of error in this analysis is so high. It's a little tough to say what the conclusion is here because the scenarios are so far apart. But our gut feeling is that it seems very likely Snap is overvalued at its current share price of $20 to $21. To be valued appropriately, Snap would need to have around a 40% chance of becoming the next Facebook. Because if you think about these scenarios in Excel, if we say 40% times a $45 average share price, plus 30% times a $5 average implied share price, plus 30% times a $2.50 implied share price, the company's implied share price is pretty close to what it's at right now. That math isn't exact, but I think you get the idea from that. It's possible for that to happen, but we don't really think it's plausible there's a 40% chance that Snap will become the next Facebook. How many other social media companies in the global market have actually replicated Facebook's success? If you assume a much lower chance for the Facebook outcome, say 5% or 10%, and a higher chance for the others, the company's implied share price might be closer to $10. Or we could say between $5 and $15. So the company's likely overvalued, but we also wouldn't necessarily recommend using it in a short stock pitch. There are no clear catalysts that are necessarily going to push down the stock price in the near term, and there may also not be good ways to mitigate risk. If we make a short recommendation and there are not many call options on the company's stock, for example, it's going to be very difficult to hedge ourselves. Also, keep in mind that in the IPO, the banks involved created a 1-year lockup period on 25% of the shares sold. So there's not going to be much downward pressure from sellers in this case. Instead, there's going to be a lot of upward pressure from people buying the stock and from these existing shareholders that have to hold on to their shares. Let's do a recap and summary now. Is Snap overvalued? Yes, most likely, but probably not to the extent that others have claimed. The company's true intrinsic value might be around half of its current share price, but it's not worthless. It's not worth only $1 per share, 50 cents per share, or $2 per share like I've seen in some other analyses. To get a sense of the company's value, you have to look at a long-term DCF over 20 years, we think, and assume revenue growth and margins based on the possible outcomes. In the Facebook case, there might be 2x upside. So the company's intrinsic value might be twice its current share price with very aggressive assumptions. In the Twitter case, the company's intrinsic value might be only 25% of its current share price with more reasonable assumptions, we think. And then the crash and burn case, the company's intrinsic value might be only 10% of its current share price with much more pessimistic assumptions. So that's it for our quick analysis of Snap. Hopefully you now understand a little bit more about how you might deal with a very speculative company in stock like this one, how to think about the different outcomes and scenarios, and how to create a valuation for the company.